Hello and welcome to this session. This is Professor Farhat. In this session, we would look at specifically one of the internal service fund that's a little bit unique to governmental accounting. And when I was going over the internal service fund, I said I might come back and cover this internal service fund, which is insurance and risk management. So this is what I'm going to be doing in this session. Now, what is the idea of insurance? Well, the idea of insurance is to transfer the risk. Transfer the risks to someone else, to another party. So that's the idea of risk management. So transfer the risk, how you will buy insurance from a third party. So some government, what they do, they will try to self-insure themselves. And how does it work? Think about if you want to self-insure yourself. So rather than paying, for example, your car insurance, rather than paying, for example, $100 a month for the insurance company, what you do is you will take this $100 and you have an account, you call it insurance, and you keep depositing $100 a month every month. Then when something happens, you will go into this account and you'll pay off any claims. So this is the idea of self-insurance. Basically, you are creating the insurance yourself. Now, in theory, self-insurance is not really insurance, because the idea of insurance is that you have transferred the risk. There is no risk transferred here, okay? So some government elect to do so, elect to self-insure themselves. And why do they try to do so? So you might be asking, why don't they just buy insurance? They think they can reduce the premium. Simply put, they can reduce their expenses. The premium is what you pay in insurance premium. Your payment to the insurance company is reduced. That's the idea of the reduction. But remember, self-insurance is no insurance because no transfer of risk to an outsider. So what happened, the company, what they would do, they will create this internal service fund, okay, which is kind of a self-insurance fund. And this fund could be just an accounting fund, basically just an account. That's all what it is, okay? But it's nonetheless, it's its own separate fund. So the companies and the government simply sets aside funds to provide for possible losses based on actuarial determined loss. So they will try to determine what's going to be their loss, and based on that loss, they'll put money away. Often government that self-insures part or all of its risk also centralize its risk financing activity, FYI, okay? Now, that self-insurance, it can be done by the internal service fund or it can be done by the general fund. We're going to look at the internal service fund, but also we're going to compare this to the general fund to see how it works for both ends. So GASB mandate that if an internal service fund is, if you're setting an internal service fund for risk management, okay, you should recognize the expense and record a liability when it's probable that an asset has been impaired, a liability incurred, or a claim will be asserted, and the loss is estimable. So basically, simply put, it's very similar to FASB requirement. Simply put, if there is a probable, you have a loss and you can estimate the loss, then you are required to record an expense, okay? And you disclose any other loss contingencies in the notes. Okay, so now this insurance department that's inside the company, that's part, it's part of the internal service fund. That's not part, it's not part of the internal service fund. It is it is an internal service fund by itself. But again, it's usually a department, basically an account. That's all what it is, okay? Act as an independent insurance company. So they act as an independent insurance company. Various government bodies, they will pay them premium. Okay, premium payment by the government to internal service fund, only a portion reported as expenditure by the government, only a portion, and we're going to see how, by the government, and revenue by the IFS. Any excess is a non-reciprocal transfer. We're going to see how, okay? So only a portion is an expenditure and obviously revenue, and anything in excess, it's going to be considered a non-reciprocal transfer. So let's see how it works, okay? So if the government accounts for its self-insurance in an internal service fund, then the premium revenue can be based on the actuarial estimate. So when we create an internal service fund to account for self-insurance, how do we recognize revenue? Based on the actuarial estimate. And we can include also a provision for catastrophe. So we could have an account for catastrophic things, things that are very unusual, but we want to make sure we protect against. Hurricane, for example. If self-insurance in a governmental fund, so now if we're dealing, if the self-insurance in a governmental fund, then the premium revenue must be limited to the actual expenditure. So the revenue, what do they consider revenue? Only the actual expenditure. Whatever they incur as expenditure, they would record as revenue. And any charges in addition to the actual claim must be recognized as an operating transfer. And the best way to illustrate this is to actually work an example, because this is how you will see this actually at work. This is how you will see this actually at work. So let's take a look at this example. So let's assume a government, so this is an example where the government is maintaining in the internal service fund, the self-insurance in an internal service fund. Okay, the government maintain an internal service fund to insure all government vehicles for loss and damages and for liability to third parties. So rather than buying insurance from an outside party, they decided to do it themselves. It establishes premium using actuarial techniques intended to ensure that over time the premium will cover claims, administrative costs, and catastrophic losses. So what they did is basically they hire an actuary and they did a study and they said, you know, this is how much it's going to cost you. Okay. In a particular year, the internal service fund bills the general fund $260,000. So now they're billing the general fund $260 and the utility fund $130. So they billed the general fund $260 and the utility fund $130. This is an enterprise fund, EF, an enterprise fund. Okay. A total of obviously of $390. That's the total billing. Of this amount, 25 is for potential catastrophes. Okay. During the year, so what happened during the year? It incurred $360,000 in claim losses. So remember, because this insurance covered for a catastrophic as well as claim losses. So only you had $360 of claim losses, none of which was catastrophic event. Okay, so the internal service fund would recognize as revenue the entire $390. So because this is an internal service fund, what's going to happen? We're going to debit cash. $390, and we're going to credit revenue $390. So they would recognize the $390 as the entire cash as revenue. Now, if we're looking at the general fund will debit, expenditure. Remember, the general fund will debit an expenditure, $260, credit cash, $260, and the utility fund, what they would do, they will debit an expense, not an expenditure. How much is it? Was it $130 and credit cash $130? This is what the other funds will do. So one will debit an expenditure and the other one will debit an expense. Okay. At the same time, the general fund would recognize an expenditure and utility will recognize an expense. Okay. Now, what about the claims that they process for $360? So the internal service fund would recognize actual claim of $360. So what happened is they debit expenses, which are claim, $360. And notice the internal service fund, we use the word expense. Why? Because we use accrual accounting. Then they credit either claims liability if they haven't paid it, or they will credit cash if they paid it in cash already. Now notice what happened overall. So if we look at the overall, the internal service fund, they had revenue of $390, expenses of $360. So basically they have a net increase in net position. But remember, of this $30,000, we still have $25 from the amount for catastrophic losses, because we did not pay any catastrophic losses, and $5,000 will be for claims. And we obviously will disclose this in the financial statement. So this is how we account for this type of activities in an internal service fund. Now we could switch the example and look to see how is it accounted for in the general fund. So assume the same fact as the previous example, except that the insurance activity are accounted for in the general fund. So rather than having an ISF, internal service fund, to self-insure, what they do is the general fund handles that activity. So the government still self-insuring, but it's being handled by the general fund. So the insurance department, notice in quote department, because basically it's an account. That's what the insurance department is. Bills other general fund departments for $260 in premium and the utility for $130, for a total of $390. As before, the government incur only $360 in actual claims. So basically we're using the same example. Okay. Now the general fund would recognize the claims as would the internal service fund, except that the general fund would report the claims as an expenditure rather than an expense. So what happened is, notice here, what we did is we debited an expense when we recognize the claim. Here what we do is we debit an expenditure when we recognize the claim. Okay? Now, how much can we recognize as a premium? That's the question next. Because how much can we recognize as a premium? Let's take a look at the rule. The maximum that the insurance department could recognize as premium from the other department would now be $360. It's the amount of the actual claim. Remember, if we're using the general fund, okay, our revenue from premium is the actual claim. The actual claim is only $360. Therefore, we can recognize $360. Okay. So how do we allocate this $360? Where is it coming from? Of this, one third. How do we come up with one third? 130 divided by 390. Remember, 390 is the total. One third. 130 divided by 390. Okay. One third of this amount. 1/3 of the 390, or 120, would be attributable to the utility fund. And 2/3, which is, remember, the general fund contributed 2/3 out of the 360, which is, this is 2/3, or 240,000 of the total. 200. This is the ratio. This is not equal to this. This is equal to 1/3 times, this is 2/3 times the amount. Okay, 240 for the general fund. Okay, so the premium would be recognized as an inter-fund reimbursement and reported as a reduction in expenditure. So notice the $10,000 that the utility fund paid above its share of its allowable premium revenue would be reported as an inter-transfer. Remember, because we're gonna be assuming that for the utility company, what we did is we covered them for their expenditure was $120. Okay, therefore we're gonna debit cash from them $130. That's how much they pay. Their expenditure amount that we spent on them is $120. Therefore, the remainder, whatever they paid above and beyond, it's considered a non-reciprocal transfer. So this is how it works for if we're doing accounting under the general fund. So this is an inter-fund reimbursement, and this is a non-reciprocal transfer. This is how we account for the $130,000 from the utility fund. So hopefully this will, help you understand how self-insurance work. It's not very common, even on the CPA exam. It may not be a very common thing to know, but FYI, I just like to cover it. If you have any questions, any comments by this from this concept, by all means email me. But this is a key slide on how to account for these transactions. Any questions, any comments, email me. Study hard and good luck.